All right, ladies and gentlemen, welcome to episode 3 of Distressed Deals Decoded, where real estate problems meet real solutions. Brought to you this week and every week by Asset Resolution Advisors. Today, we're going to dive into another issue that's really emerging for real estate investors and for real estate sales agents to just garnered tremendous opportunities. Our topic today is the Great Reset, how COVID and post COVID policies created today's perfect storm in the housing and mortgage markets. Couple of thoughts. COVID didn't just pause the housing market, it
Mhm.
broke it. And we're still living with the fallout of all of that change. And the policies designed to protect homeowners during COVID are the same ones crushing affordability today. Believe it. Default rates were under 2%, very normal just two
Mhm.
years ago. Today, they're approaching 4%, and FHA and VA are spiking. That's a big deal, ladies and gentlemen. The question is, how did we get there? Today, we are going to learn how all this happened, why all this happened, and what comes next, and how agents and investors can capitalize on it right now. My name is Patrick with Asset Resolution Advisors. I'm a real estate broker and part of the team. I'd also like to introduce my two other guest hosts, Mr. Stephen Schiller, the head of operations for Asset Resolution Advisors, and a loss mitigation expert, and what I lovingly refer to him as a reformed loan servicer. And of
Mhm.
course, we wouldn't be complete without our expert panelist and investor, Mr. Juan Nicasio, Mr. Acquisition himself. Juan will bring this discussion into the hands of all of you that are watching this in our community from the perspective of the investor and the real estate agents. So you're going to
Absolutely.
get to hear from these folks right now. So, Steve, let's start off with the big question. What actually happened during COVID that broke the normal delinquency cycle?
Yeah, so amazingly, when COVID happened, the government needed to figure out a way to provide relief to homeowners, right? People stopped working, they didn't have incomes. So the answer was, hey, let's put everybody on a forbearance. The problem that resulted in it was how do you distinguish who got hurt by COVID, right? Was it this person, that person, a person who was current, a person who wasn't current. So they didn't really delve into it. They just said everybody gets a
Mhm.
car. No, everybody gets a free pass, right? So you get the forbearance. So it didn't matter if you were current on your mortgage on the day COVID happened, or if you were 2, 3, 4, 5 years delinquent on your mortgage. Everybody got treated the same. So that was the first issue is people who hadn't made payments in 2 weeks, 2 months, 2 years, 3 years, 4 years, all had the same approach to
Mhm.
the forbearance plan. So they all got all their issues reset. Didn't solve their financial issues. It just simply reset their mortgage. So that reset, the great reset here, was really the start of everything that nobody really contemplated at the time. It was more about providing relief. So it was just this big eraser, right? That's why we saw the defaults plummet to all-time lows. And foreclosures, it didn't just stop from the moratoriums. It never really recovered. Nobody ever got back to it again for a lot of different reasons that we'll go into.
Okay. So Juan, adding to this misery of post-COVID, what other things happened in the marketplace that have exacerbated these
Well, I
problems?
mean, we had bankruptcies also drop, half of historical averages, creating a ginormous backlog that, continues to pile on still to today, right? And so, you have a lot of different things as far from a servicer standpoint, where remember, folks still got laid off. Some folks that were working from home, no longer working from home from the servicer companies, meaning you don't have the right people servicing the loan along with the backlog. You have borrowers that learn how to delay and pause these foreclosures, right? And they didn't need to sell a home, so you have all of that in conjunction with creating a stagnated market for everyone, right? Um, Now, from a wholesaler and investor standpoint, this created, a really good period for a short period of time, right? Like you could have capitalized between 2020 and call it 2023 when the interest rates were low, where you were able to still save people from a foreclosure because they were not being foreclosed on. So you have time to acquire these properties. Uh, Obviously, with the lack of inventory in the market, because most people were not moving, that spiked, the pricing for these homes. So you, as an investor or as a real estate agent, this was a magical time, right?
Mhm.
Because now you're demanding, right, high premium for your property because a lack of inventory, right? You had to create this inventory. So you could ask whatever you wanted as a homeowner, and you probably got it. So even if you were in bankruptcy or you were in foreclosure, this period in time, this small period in time, those 3 years, if you capitalize on the timing, well, you did really well because yes, you could have been negative at that moment, call it 2019, 2020, on your balance, right? On your mortgage balance. But because of what happened, now you forced appreciation due to, obviously the backlog that we had and the lack of inventory. So it was a dream for real estate agents to sell property as is, how is, 0 day inspections, close quickly. People were just flooding the market, investors as well with their fix and flip. It created a dream because they bought it today, and by the time they were done with the renovations, maybe you saw an additional 4, 5, even 10% increase in the after repair value, right? So on paper, this is fantastic, right?
Yep. So kind of sounds a little bit like 2008, doesn't it? So we
Yes.
saw the behavior of the default industry go on its ear when COVID hit. Let's call that chapter one. Well, now chapter two emerges, and it's the slow return. The
Mm-hmm.
foreclosure moratoriums truthfully didn't end until about 2024, even though on paper the moratoriums ended in 2021. Most people heard that they were over and everything was normalized, but folks, that's nowhere close to reality whatsoever. The system didn't reset. The backlogs, the delays, the distortions have been compounding ever since. And guys, we deal with that every single day and we see it, but you don't hear about it too much on the news anymore because there's other more important stuff captivating the eyes and ears of the American public. So even the servicers, quite frankly, were incentivized to delay those actions because volume was low, staffing was reduced. And Steve, you and I see that all the time dealing with these banks. They have offshored just about everything, and no longer do you have the folks that have been doing it for years, but it's a whole new ball game. So talk to us a little bit about this moratorium ending.
Yeah, so the mortgage moratorium ended in 2021. But quickly the government saw that people weren't recovering as quickly as they could. So, what ended up happening were protections were added on to the moratoriums. And from a mortgage standpoint, don't forget that there were still some moratoriums that went past 2021. Like for instance, the student loan moratoriums, I think, ended in 2024. So, when you start looking at all the little pieces, people were finding different ways to essentially delay what they were doing, right?
Mhm.
Actually, the student moratorium ended in 23, not 24. And so by being able to after 2021, so what happened with the moratoriums in 2021? That ended, and you were allowed to essentially at the end of 21 have a forbearance continuation for up to 2 years. So that puts us into 2023. Well, anybody who took that forbearance often were offered an additional time frame post 2021. So while it ended 2021, that was only for new people. Anybody who
Mm-hmm.
was in a forbearance already were allowed to offer a second one, and some
Mhm.
of them went 2 years. So you basically had t- about a 2 year period post moratorium, which was 1 year, that you didn't really have to pay, that you can reset everything. So when you start looking at this, if you're a delinquent, like we said before, if you're a delinquent coming in and you got the reset and then you did the forbearance and you were offered a second forbearance, you essentially, there are probably people who hadn't paid in 4, 5, 6 years at that point, and all the interest is still compounding. and accruing and late fees and everything else. And they just went back on the forbearance. So it was added back into the loan. So now you really have a big upside down loan, which I think we
Mhm.
saw what happened in 2008 and 2009 with upside down loans.
Yep.
Yep, big
Yep.
time. So
Yeah.
Juan, do you have anything to add to this piece?
I mean, yes. I mean, the system stayed, artificially quiet until these programs fully ran out. Now, understand that the consumer, right, the borrower wasn't really educated with what a forbearance is, what would be, the repercussions of a forbearance. I've seen many, many cases where agents and real estate investors, they go through a purchase process to then later find out that the homeowner had a forbearance and that all that interest late payments were on the back end. So now that deal is no longer a deal, considering that there's not enough margin, right? The person's now upside down. They thought they only owed the principal and interest that they had back when they went in forbearance. They forgot about the additional interest. And what I've also seen, which was a little different, I'm not from the mortgage side of things like you guys are, but it seemed like a lot of them showed that forbearance as like a partial claim or a second mortgage, which was very confusing for a lot of homeowners. They're like, I never took out a second mortgage. What are you talking about? But when we pull the title and lien search, it would show as such, right? Which just caused such a big issues with a lot of the deals being put together. Real estate agents couldn't close the deal because obviously there was no equity for the homeowner, and typically they didn't know how to work that type of case. This is why we have our community to educate you on how to get it across the board, even if something like this were to come up. And then the investor, they just need to quit on the deal because if there's no equity, there's no deal, right? So
Yep.
those are the problems that continue to brew after this whole COVID ordeal.
So then let's turn the page to chapter three of this story. So, because we're seeing these things compound, we run into something that we refer to as the stacking problem
Right.
between 2020 and 2024's runaway workout programs. Everything we've been talking about right now, all of a sudden, there it is sitting on the table. And if you
Mm-hmm.
are an uninformed consumer, as the home seller, Juan, you said it. You're going to get a big surprise coming at you if you've been going through these programs and you haven't been making mortgage payments for potentially years. Your lifestyle needs to come to an abrupt halt. So let's talk about this stacking issue. If they live for 3 to 4 years without paying, as we saw again back in 2008, there's all kinds of issues that compound that. Partial claims, streamlined modifications, COVID modifications, FHA standalone partial claims. You could go down the litany of jargon within this industry, but it really comes down to a couple of very important points. Steve, why don't you shed some light on that for us?
Yeah, I mean, I think the first, I think the first thing to really discuss is we as an industry, a mortgage real estate industry, everybody said, oh, everybody has so much equity in their homes, but they never took this stuff into account, right? And because to Juan's point, some of it was quote unquote hidden, right? Yeah, they filed the partial claims or yeah, they did the mods, but it doesn't show up in the data the same way a new loan does. And so it was hard for real estate investors and even in some cases agents to really figure out what the situation was on some of these distressed assets, and they just didn't know what to do, right? A partial claim is a silent second.
Mm-hmm.
And it was just put on pretty frequently in VA and FHA loans. You had a lot of mods that just went and modified the loans that it basically didn't show up in recordings, but it was done. So all of those forbearances, mods, it just stacked. It really stacked all the past due amounts that didn't show up in your mainstream data. So that was part one. And so from a homeowner standpoint, right? Again, it's 2020 all the way to 2024. They're just stacking these up, right? Oh, I do a forbearance for 2 years. Oh, I can't pay after 4 months. Let me do a mod. Okay, let me do a partial claim. Oh, let me do another mod. Let me do a partial claim. I mean, essentially, people went 5+ years without making a payment on these. And
Right.
so Now in 2025, with essentially with a new administration and a new a new direction, what essentially happened was, yeah, we're stopping all that, no more of this, we're just gonna let things happen and see what plays out. I think that's partially the right way, right? Let the market determine what goes on, but they've also added certain things to FHA programs where foreclosures now have to be bid at full debt, total debt. VA for a while in 25 weren't foreclosing on veterans early on in the year, and then later, that expired. So there's just a lot of little things that kind of popped up in between. They weren't nearly as widespread as the previous administrations, but they were still things that were able to stack on for people, right? Veterans, as long as you're living in your house, you would
Mhm.
never get foreclosed. There's nothing about payments or forbearances. So nothing stacked in that case, but interest continued to accrue and they just became more delinquent. They just weren't kicked out of the house. That finally expired. So we're getting back to what's the new normal, but that's we're just at the beginning of this new normal, right? Probably within the last 6 months, we started seeing a lot of the degradation in the mortgage market, right? Bankruptcies are going up, continue to go up, defaults go up, and I think that's where the opportunity lies.
Hey, Steve, real quick before we jump into Juan and his take on this, could you define for our audience what a partial claim is? I know there's a lot of people
Yes.
saying, I don't even know what
Yes.
that means.
Yeah, so what FHA and VA did was they took the loan and they said, "Hey, you're based on your delinquency, the value of the loan is more than what the property is worth." So let's take, for instance, a house, right? You had a loan that was $250,000. You didn't pay for a couple of years, and now you owed with interest 275, but your house is only worth 210. What they
Mhm.
would do is they would say, okay, we're gonna take $65,000 of what is owed. We're gonna make it into a 0% second mortgage that doesn't accrue interest, but will be a second lien on your house. That is the partial claim. So they're claiming that $65,000. They're putting a lien against the property for that. They now modify the loan down from 275 to 210 because that's the value of the house. And now they start servicing the loan based on the interest rate of that mortgage at $210,000.
Mhm.
So, Juan, how does this affect you as an investor?
No, well, I mean, this has been huge, right? Because I know that we're talking about normalizing, but I see it a slightly different. Yes, normalizing from a standpoint of like things are coming back to normal. It won't be as crazy, with the volatility or tremendous appreciation that we saw in the last couple of years. But my biggest concern is the following. Number one, we have more and more people obviously filing for bankruptcy and going through this financial distress, which means that there's a lot more inventory. When there's more inventory, well, then typically you have depreciation, right? Because if you have, let's just say, obviously like supply and demand, if you have 100 listings, last year, and now you have 200 listings, well, that tells you that investors and have more options, okay, to find properties and do negotiation. If you're a neighbor of mine and you're selling a property and I want to sell my property, first thing I'm going to do is probably lower my price, right? If I have the same home. So that trickle effect is going to cause, a pretty significant decrease in the market, creating even less equity, a lot less equity in the homes that were purchased between, call it, 2020 and 2024, 2025, because we still see it today. People are still overpaying for property, believe it or not. Even till today, like, I feel the prices of homes, yes, they've come down just a little bit, but they're still high, and so is these interest rates. These people cannot afford the higher interest rates. For the investor, though, there is that opportunity still from the 2019 to mid 2023 to be able to capitalize on those lower interest rates, right? People that locked in anywhere from a 2.3 all the way to maybe 4.5%. You could, in essence, again, and every state you got to check your laws. We're not attorneys. This is not financial advice, but you can in essence help those homeowners get out of those deals by assuming their monthly payments, right? Doing like sub two type of deals so that they're able to start over, they can move on, and then you lock in that lower interest rates as so long as they're not so far behind where they owe more than 20, 30, 40% of the value of the property. At that point, does it really make sense? Maybe not. And so there is opportunity in these type of deals. You just got to be very selective and do your homework, understand what type of loans you could assume, or you could partner up with a lot of these homes, because this is something people don't talk about. When folks cannot afford their property and they're asking for forbearances, okay, typically these folks could genuinely be hurting for cash. Okay. If they're hurting for cash, well, then that means that the home also has deferred maintenance, right? So appliances break up down, cabinetry, your roof, right? Big ticket items. So now that leaves an investor the opportunity to come in there, find a deal that still has a good amount of equity on paper, but the property needs to be modified, or rather renovated, to extract that equity, right? So they may be in bankruptcy, they may be in foreclosure because financially they can't afford it, but there are still properties out there with low interest rates, with equity on paper, and just needs a pretty savvy investor to go in there, partner with the homeowner, fix the property, and extract the equity on the back end. So that's
Got
what
it.
I see from this particular market. I think that's where some of the opportunities lie for those are investors and or real estate agents.
Okay. So, hey, what is this? That's a bubble popping.
That is a
So,
puzzle. It is a puzzle.
chapter 4 of today's wonderful video podcast, the bubble pops. So, we're at the tail end of 2025, folks. Amazing how fast this year's gone by. 2026 knocking at our door. What does the data show? Juan, you said it. We know that bankruptcies are up 30% annually since 2021. Bankruptcy happens for a variety of reasons. One
Mhm.
of the big ones is to help people hold back the foreclosure, right?
Right.
To give them some time to rethink their plan. Steve, talk to us about this.
I mean, is the bubble popping? For sure. Is it going to be as big as the '08, '09 Great Recession? I don't think so. Um, you know, Defaults right now are pushing 4%, so we're definitely seeing a strain in the market. But back in '08 and '09, we were at 7. I mean,
Mm,
7 or 8, so we were almost double. I don't know that are we going to push up more, maybe a little bit more, but I don't think it's going to go up to 7 or 8. I don't think it's going to be anytime quick. FHA, VA are definitely spiking, just because they were the most exposed based on the programs, more
yep.
more than anything, with the forbearance and the mods and the partial claims. So that's common. I really I see this as just being prolonged. Like, I've been looking and watching bankruptcy um, filings over the last 3 years, and to be honest, I thought it was going to spike. And based on the data, we lost half the bankruptcy filings in COVID, and I thought, oh man, all those people who should have filed are going to file, and just really hasn't happened. And it's been an increase, and it's been a steady increase back to normal. I think it'll go above normal, but the thing we've really seen just in the market for a variety of reasons is just it's there is stress in the marketplace, but it's just not going to be this huge pop. It's going to be a smaller pop. And I think the good part for real estate agents and for real estate investors is this is probably going to happen over the next 2, 3 years,
Yes.
possibly. Good at least through 2027, possibly into 28. A lot of things can happen, but I think that we're just going to get back to this. It's going to take we get back to a new normal, and it's going to take time to do it, which I think for everybody is a great opportunity.
Yeah. Normal. That's a weird word, isn't it?
No.
What exactly is normal today? So, Juan, foreclosures, we're talking bankruptcies. Regulations. You're the investor. Where do you see this taking us?
I mean, look, foreclosures are still not normalized. We don't even see a lot of inventory on the auction sites, right? Which is going to be a really great opportunity once, right, we fix the understaffed problem with on the servicer side, and obviously provide hopefully somehow some better training, because again, like Steve had mentioned, these people that are working at the servicer level that have to process these type of deals, these folks are out of our country, right? Like these people are not here native. They're not in our offices. And unfortunately, with COVID, the layoffs, didn't help us. The talent that was hired was, very new, like people that have zero idea of what loss mitigation is. They're being trained still, and I know Steve does a great job with the connections that he has to try to educate them on how that process goes, even when he's not part of those companies. He's just, he's servicing, or he's helping to service the banks, or the investor or the real estate agent that's calling the homeowner to try to put these deals through the process. This guy is one man, right? I understand there's maybe a handful of these specialists, not very much. And so we're going to see that slow momentum with this foreclosure. So this is probably going to last a good 2 to 3 years, like Steve had mentioned. The CFPP enforcement essentially collapsed. We have fewer guardrails, more borrowers are confused more than ever, and there's just fewer consistent outcomes. So the benefit here is that if you can take, as a professional, real estate professional, an agent, investor, what have you, and even a real estate attorney, if you understand this distress asset class, right, and can get yourself in front of these homeowners and people that need this help, well, you're really going to shine in this type of market, because again, not too many people know how to maneuver around these types of deals, right? And so from an investor standpoint and a real estate standpoint, you guys can knock on those doors and be that solution to these folks that are going through these tough times.
Yep. And it's kind of like, telemedicine now, right? I mean,
Sure.
back in the day, you used to have to go and visit your family doctor and
Yes.
they would poke you and prod you. Well, since COVID, even more so, I get on the Zoom call with my doctor and they go
Mm-hmm.
through a whole bunch of stuff. Well, the same thing is true with what we do at Asset Resolution Advisors, that you may encounter two deals that look very similar, but once you triage them and understand what's going on behind the scenes, they can be two vastly different outcomes, two vastly
Mm-hmm.
different procedures. So, Steve, why are we saying that the perfect storm is really just beginning right now? What's coming in the next 12 to 24 months?
Yeah, so servicer staffing is still low, as Juan said. Um, Outcomes are just slow from a loss mitigation standpoint. So is foreclosure. They're just not getting through the system as quickly as they used to be. There's new delinquencies that are coming into the system. So you're understaffed. You don't have people trained as well as they used to, and now you have an increase of what you normally see. That's the perfect storm. So it has to work itself out. You now have courts, right? The courts are still working through backlogs and foreclosure and bankruptcy. There are less bankruptcy trustees out there. There are less judges out there. So everything's just on a smaller scale than what it used to be. Again, we're seeing the early stage delinquencies are starting to become serious delinquent. And the FHA and VA inventory is continuing to increase on
Mm-hmm.
its delinquencies. So you just start adding all the little things. And again, it's not this dump of information all at once. You don't have the issues you had in '08 and '09, which was just far more complex than what we're talking about, right? It had to do with the securities, and it had to do with second homes. And these are primary homes, and these are people's homes. And the data itself is just so different than what we had in '08 and '09. And I think what we're working through and what we're going to see and where the opportunity lies is just we're going to see this normalization of back to where things should be and where it needs to be, pricing and what people can and cannot afford, and then bankruptcy and foreclosure. It just all has to work out, and it's just going to take time, which honestly is not a bad thing.
Hmm. Interesting. Time is not on our side every time, but in some
Mhm.
cases, I guess it can help. So, for the professionals, our whole reason for being here today and every week as we do our distressed deals decoded, what are the opportunities for the professionals that are listening? And these professionals, as we've discussed, include real estate investors, real estate agents and brokers, even real estate attorneys. We're going through another perfect storm, another distress cycle. Steve, what do you see as some of the opportunities that folks should be really paying attention to today?
Yeah, so this is just going to be very different than 08, 09. There are short sales out there. I think they're really good opportunities for short sales. There are a lot
Mhm.
of agents and investors who don't understand the short sale process. It can be scary. A lot of them walk away from them. So I think that's definitely one thing for agents and investors to start embracing. I'll ask Juan here in a second something about that from an investor standpoint. There are different workout issues that need to be worked on from a real estate standpoint, right? It's not just short sales. There are liens and judgments and HOAs and excuse me, and things that agents really are staying away from, but that were caused during this COVID era that might need workout and need professionals to understand how to do that.
Mhm.
So Juan, from a short sale perspective, what are the opportunities for agents from a fix and flip perspective?
So for the investor side, personally, I look for short sales where you have a lot of deferred maintenance or, distressed property, like the actual property itself is very distressed. There's a ginormous opportunity there because that's from my experience where you get the biggest discounts on the asset. So the asset that didn't have the equity needed in order for it to be a healthy investment can now become a healthy investment if you're able to go ahead and work those type of deals through a short sale. So for me as an investor, those are the ones that I look for. Now, as from an agent standpoint, because of what we talked about, how now we have a lot of negative equity in the market for a real estate agent. This is a gold mine because you are able to basically guarantee 2 to 3% commission on these type of deals that no one wants to work because they don't know how to work them. So from the short sale standpoint, that's where I would dive, head on as an agent to become like the short sale expert, and or partner with a company like, Asset Resolution, because you can go ahead and stack so much inventory, so many listings that you will absolutely dominate this particular market and continue to ride the wave once we get out of it. It's going to be some years. So what are you going to do, right, when you have a ton of assets that don't have equity as an agent? Where are you going to go? What doors are you going to knock on?
So Patrick,
Yeah,
let me flip the script to you and ask you a question.
sure.
So, as a real estate professional and agent who's been in the distressed market, one of the things we talk a lot about, especially in this, is not just about short sales and not just about delinquent. The word we're using is distressed, right? These are distressed assets.
Yep.
So, from your perspective as an agent, what are the different things that you've seen in what we do that agents and even real estate investors should know about? What qualifies as distressed and what should they be looking for in the
Yep.
distress market?
Very good question. And why we started the community that we started, and we'll share with you how to get into that as part of school, is so that we can link together the chain of necessary players to make this happen. I'll give you an example. This is not one of our deal discussion days, but for example, we had a real estate agent bring us a short sale opportunity. It was in the great state of New York. And as we're going through this listing and sale process, the normal stuff, we found out that there were some inconsistencies with the loan. And lo and behold, this 250 some odd thousand dollar mortgage poof, evaporated. Well, now all
Mm,
of a sudden that became a tremendous investor opportunity when it was really just going to be a listing opportunity for the real estate agent. So realtors who, by the way, the population has really come down from 2 point some odd million to now just over 1 million. There's more out there for less people, but the less people need to be better tooled at how to identify the opportunities, how to triage the opportunities, and then how to dispose of them. Who is the right person to buy these properties? They should be working with, first and foremost, qualified real estate title companies and or attorneys that can do these things that really understand the play. They really need to be working with groups like asset resolution advisors, or specifically us, to manage through the triage and the resolution of these situations. And then ultimately that investor may be the person to take these deals out. By
mhm.
having that food chain in place, as the investor, I know, Juan, you do it all the time. You're beating the bushes. It's great to have bird dogs out there, though, because the real
Absolutely.
estate agents, unless they're also investors, really are there to transact a deal. They're looking for that buyer, and the one that can come back over and over again with deep pockets or access to money creates a tremendous opportunity for everybody to win. And by the way, so does the homeowner. They win too, because in these distressed situations where whether it's the property itself that's distressed, or
Mhm.
more commonly, the financial scenario of the homeowner, they come out winners too. Foreclosure is the worst case scenario for them.
Right.
And
Right.
the big question of the day is, well, where do I go if I sell my house? The same place you're going to go when the bank kicks you out of your house. So start thinking about that right now. It's an important decision to make. Do it on your terms, not the bank's terms. All right. So let's talk a little bit about the value of our school community. Juan, why don't you share as a member and a partner what you see as the value for our.
Right. So very similar to what you mentioned. This is a place where we confuse the two, right? We confuse the investor and the real estate agents to collaborate, number one, right? So if a situation like what you just described came about, well, you can marry the two, right? You have the listing and you have the investor right within our community. Not only that, but you get the proper education so that you're armed to be able to handle these types of deals, right? You are able to identify them, you're able to speak on it, you're able to be the hero with that homeowner because you have 30 years of experience being poured out into you. You have a panel of experts that you can come to with said deals so that we can underwrite it and let you know, hey, this is a great opportunity for you to pursue, or maybe not, right? So those are some of the tools that we're able to provide within the school community. I mean, it's tremendous value, specifically like you mentioned, like you had 2 million, agents out in the field. Now you have 1 million. That's 50% of them. So what are you going to do to differentiate yourself from the others in this market that we're going into? And I know that this particular community is built specifically with that goal in mind, is to educate you and collaborate with you so that no deal goes unturned.
Excellent.
And
Oh, go ahead.
no, I was gonna say one of the goals when we came up with this was, to Juan's point, at first it was, hey, work with us, work with us, work with us. And we started understanding that agents I mean, real estate investors, they had questions, right? They wanted to know, they wanted to do it themselves. They wanted to educate themselves. They wanted to understand how to do the deals. And so we found this is our way of being able to answer those questions, to get to get agents and investors understanding of what goes into the deals and how to do the deals if that's what they want to do. And at the same time, they also have access to us that, hey, you don't want to you educated yourself and you don't want to do the deal yourself, then you have professional who can help you. In addition to that, again, to say it again from what Juan's saying, you're in a community that others can help you, right? Sometimes you have a listing and you need an investor and you don't have the right investor. This is a community that we want to bring people together. You might have an agent, you might have a seller who doesn't know where to go and doesn't know what to do. You might be able to find a real estate investor who has a single family house that needs a tenant, right? And so there are a lot of different avenues for this community to build upon each other and help each other, in addition to distressed asset part of the market, right? One of the things we see actually in a distressed asset is people are in bankruptcy. They have equity in their home, but they
Yeah.
don't know where, they can't afford their home and they don't know where to go. That's what this community is about, is helping each other find those solutions and guide people into the right direction.
Yep. And over the years, how many properties have we seen that were in bankruptcy, specifically the homeowner filing to try and get some protection, ends up back into foreclosure because the process was broke. It didn't work the
Hmm.
way they wanted it to. And they end up with a bankruptcy and a foreclosure. So, folks, if you're working on a short sale, you're up in front of a bankruptcy property, you can't deal with the trustee. There's probate issues, judgments, liens. UCC liens and solar panels. We're going to talk about that in one of our upcoming meetings here. We're here for you. Asset Resolution Advisors is here to help. So wherever you're going to be watching this video, subscribe, follow us, send us your toughest deals, like us, just like us anyway. We're good guys. We turn problems into closings. So without any further ado, we will talk to you next time on our next episode of Decoding Distressed Deals. Talk to you soon.